Have you ever heard people talking about index funds, mutual funds, hedge funds, or ETFs and thought to yourself, what in the world are they even talking about? Don't worry, you're definitely not the only one. These names sound complicated, but the truth is, once you really understand them, they're much simpler than they seem. Today, I'm going to explain all of them to you in a way that anyone can understand. No big financial words, no confusing charts. Just clear and simple explanations, lots of real examples, and stories that will help everything click in your mind. By the end of this video, you'll understand how each of these funds works, who they're made for, and which ones might actually make sense for someone like you. Before we talk about the different kinds of funds, let's first understand what a fund even is. Imagine you and your friends want to buy something really cool. Maybe a huge cake for a birthday, or a soccer ball, or even a new gaming console. It's too expensive for one person to buy alone. But if everyone puts in a little money, suddenly you have enough to buy it together. That's exactly how a fund works. It's a big pool of money that lots of people contribute to. The people in charge of the fund then take that money and invest it in many different things, like company stocks, bonds, or even real estate. And just like how you and your friends all get to share the cake, the people who put money into the fund share in the results. If the investments grow, everyone earns a piece of that growth. If the investments lose value, everyone feels a bit of that loss too. So now that you understand the idea, let's look at the different types of funds, starting with one of the most famous, the index fund. You've probably heard people online or in finance videos say things like, just put your money in an index fund and forget about it. But what exactly is that? Well, an index fund is like a copy machine. Instead of trying to guess which company's stock will do best, it simply copies a list called an index that represents a portion of the market. For example, one of the most well-known indexes is the S&P 500, which includes 500 of the biggest companies in the United States. Companies like Apple, Microsoft, Amazon, Coca-Cola, all in there. If you buy an index fund that follows the S&P 500, you're basically buying a tiny piece of all those companies at once. So when the index goes up because most of those companies do well, your investment goes up too. When it goes down, your investment might fall a little, but not too much because you're spread across hundreds of companies. That's the magic of index funds. They spread your money around so that you don't rely on one single company to succeed. It's like having a big basket filled with fruit. Even if one apple goes bad, you've still got plenty of others that are perfectly fine. And here's the best part. Index funds are passively managed, which means there isn't a person sitting there every day picking what to buy or sell. The fund just follows the index automatically. That makes it simple, reliable, and really cheap to run. Most index funds only charge a tiny annual fee, sometimes just a few cents for every $1,000 you invest. Another thing to know about index funds is that they aren't traded all day long like regular stocks. They're priced only once a day after the stock market closes at something called the net asset value, or NAV. So if you buy during the day, you won't know your exact price until later. But that's totally fine because index funds are designed for long-term investors, people who want to grow their money slowly and steadily over years, not minutes. Index funds have become so popular because they're easy, affordable, and surprisingly effective. Even Warren Buffett, one of the greatest investors of all time, says that most people should simply invest in index funds rather than trying to beat the market. Because here's a fun fact. Most people, even professional investors, fail to do better than the market in the long run. Now let's move on to mutual funds, which are quite similar to index funds on the surface but have a big difference underneath. Like index funds, mutual funds collect money from many investors and invest it in a mix of different assets, stocks, bonds, and sometimes other things. But while index funds just copy an index, mutual funds are usually actively managed. That means there's a team of professional investors, fund managers, who decide what to buy, what to sell, and when to do it. Their goal is to beat the market, not just follow it. That sounds great in theory, right? A smart professional handling your money, trying to get you the best possible returns. But here's where things get tricky. Managing a fund costs money. And because these professionals need to be paid, mutual funds usually charge higher fees than index funds. Instead of paying maybe 0.1% a year, you might pay 1% or even more. And here's the kicker. Despite those higher fees and all that management, most mutual funds don't actually perform better than simple index funds over the long term. Still, mutual funds have their place. Some people like them because they believe in a particular manager's strategy, or they want access to specific industries or countries that aren't available in index funds. For example, someone might buy a mutual fund that invests only in small new companies or in certain parts of the world like Asia or Latin America. Big companies like Vanguard, Fidelity, and JP Morgan all offer both active and passive mutual funds, so it's always good to check which kind you're getting. And just like index funds, mutual funds only update their prices once per day, at the market's close. You can place an order anytime, but the final transaction happens after trading hours. Now let's move into something a little more mysterious. Hedge funds. You've probably heard that term in movies or maybe read about billionaires who run hedge funds and make huge profits. But what exactly are they? A hedge fund is basically a private investment club for very wealthy people or big institutions. The word hedge means to protect, but the truth is, hedge funds often take big risks. They're not open to everyone, only to what are called accredited investors, people with lots of money or high income, because these funds can use complex strategies that ordinary investors aren't allowed to take part in. Unlike index or mutual funds that focus on regular stocks or bonds, hedge funds can invest in almost anything: real estate, foreign currencies, commodities like gold or oil, and even bets on what will happen to the economy. They can borrow money to invest more, that's called leverage, or bet against companies they think will fail. That's called short selling. All these tools give them a chance to make very high returns, but also to lose a lot. Hedge funds are known for their high cost too. The typical hedge fund fee model is called 2 and 20, meaning they take 2% of your total investment every year just for managing it, plus 20% of any profit they make for you. It's a lot more expensive than index or mutual funds, but investors agree to it because they hope the fund manager can deliver huge gains. Sometimes they do, but other times they don't. Hedge funds can make fortunes, but they can also collapse overnight. Think of hedge funds like super fast sports cars. They're powerful, exciting, and can get you to your destination fast, but if you're not careful, or if the driver makes a mistake, they can crash just as quickly. That's why hedge funds are only for people who understand the risks and can afford to lose big if things go wrong. Finally, let's talk about ETFs, which stands for Exchange Traded Funds. ETFs are kind of like the cousin of index funds. They share a lot of similarities, but they have one big difference. While index funds are priced only once a day, ETFs are traded on the stock market all day long, just like regular company shares. You can buy and sell them whenever you want during market hours, and their prices change throughout the day depending on supply and demand. Most ETFs are designed to follow an index too, just like index funds, so you can buy an ETF that tracks the S&P 500, or one that follows the price of gold, or even one that invests in clean energy companies. Because ETFs are easy to trade and usually have very low fees, they've become one of the most popular ways for regular people to invest. You can start small, add a bit every month, and over time watch your investments grow. Now that you know what all these funds are, let's quickly wrap it up. Index funds are simple, cheap, and great for long-term investors who just want to grow with the market. Mutual funds are actively managed and can sometimes beat the market, but they usually cost more. Hedge funds are for the rich and the bold. They chase big rewards but come with big risks. And ETFs are like index funds you can buy and sell anytime, giving you flexibility and variety. For most people, index funds or ETFs are the smartest and safest place to start. They're easy to understand, affordable, and designed to grow with time. The truth is, investing isn't about getting rich overnight. It's about being patient, consistent, and letting your money work quietly in the background. Even if you start with just a little, over the years, it can turn into something amazing. So take what you've learned today and use it as your first step into the world of investing. The more you learn, the more confident you'll feel. Remember, every big investor started somewhere. And maybe today, that somewhere is right here with you. Smash that subscribe button, leave a comment, and see you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.